Hi, everyone. Thanks for making today's webinar. We'll just give it another couple of minutes before we start the webinar. We'll just let some of the attendees come in. So guys, just give us a couple of minutes before we start. So we'll start at 10 sharp. So thanks all for making it. So for those that are just signing on now, give us another minute. We'll be starting the webinar shortly. If there was any questions or anything beforehand that you wanted the panelists to address, there's a Q&A function at the bottom of Zoom. So if you want to, put that through now or later, feel free. But we'll just give it another minute and then we'll start today's webinar. But really appreciate everyone's patience. All right. So I guess, I'll just introduce myself, everyone. So thanks everyone for making today's webinar about setting up a fund here in Singapore. My name is Omar Tahiri and I chair the board for ASCENT in Australia. And obviously very excited to have this esteemed panel here that will cover the whole Singapore landscape. And, it's been an extremely interesting year for the fund setup industry in Singapore and in Hong Kong. I guess, introducing these appealing new fund structures with, excellent tax incentives, which have been modeled on international best practices and really designed to attract institutional capital. And I guess now having over 200 family offices also set up in Singapore and attracting the likes of Ray Dalio, Sergey Brin, it just shows that there's immense benefits in having your fund set up in Singapore, and it's really benefiting the entire ecosystem, ranging from the service providers to the investment managers, and even the unemployment rate here in Singapore. So we thought we'd put together a panel discussion with all the different service providers from the ecosystem here today. And the format for today's discussion will be each of the presenters will be presenting 10 to 15 minutes on their subject expertise. I'd really encourage the audience to ask questions via the Zoom function. And at the end of it, we'll have a panel discussion. And anyone that wants to address any questions, you can again do that at that time. And we want to make this as interactive as possible. So with that being said, I'd like to introduce our first speaker, Mr. Brandon T. Brandon runs his own law firm here in Singapore called BTP Law. Brandon has been setting up a lot of the new VCC structures here in Singapore. And, he's an entrepreneur and a lot of our clients have used Brandon and his firm. So he'll be giving a presentation on what it takes to set up a fund in Singapore and also the different options you should be considering. So Brandon, with that being said, please, the floor is yours.
Thanks. Just let me share my screen. Yeah, hi everyone. I'm Brandon. So as Omar mentioned, I run my own firm called BTP Law. We're a boutique firm that specializes in fund formation space. Today, we're going to cover how to set up a fund in Singapore, some of the considerations, and I think given that the VCC is sort of like the newest structure in Singapore, we're going to cover a little bit about that at the end of the presentation as well. So without further ado, I guess, as mentioned earlier, these are the topics that I'll be covering. Firstly, why Singapore as a fund domicile? Number two is what are the types of licensing exemptions that are available and that are required before you can have a fund management service business in Singapore. Number three, the various structures that are in existence in Singapore and just a short comparison of the various options out there. And as I mentioned earlier, the variable capital company, which was introduced in January of 2020. And I'll go through some of the features of the VCC. and what are some of the requirements and limitations of the VCC from a practical experience standpoint. Overview of the process of forming one, as well as some of the applicable tax incentives, and lastly, the MAS grant scheme for the VCC. Okay, so why Singapore? I guess a lot of these reasons people are generally quite acquainted with. Firstly, friendly business environment, political stability. I guess this has become more of a salient point in recent times, with other jurisdictions having some of these issues. Strong reputation and infrastructure, tax efficiency. I think this is quite important, as well as its access to over 90 tax treaties, availability and quality of the professional services ecosystem in Singapore, as well as the rule of law and investor confidence. So coming on to the licensing regime in Singapore, generally speaking, for private funds, the space is regulated through the CMS regime. And so the sort of requirements that are imposed on the fund structure itself is fairly light touch, depending on what kind of exemptions you utilize. So because the MAS regulates the space primarily through the licensing regime, so it's not that easy to get a license, and it takes a bit of time as well. Generally, there is a license and there's an exemption. So the license is typically either the retail LFMC, the accredited and institutional LFMC, or more recently the VCFM, which has slightly lower requirements in terms of both quantitative and qualitative requirements. Then the exemption is the RFMC. As you can see in the table below, the RFMC has certain limitations, primarily in terms of AUM, no more than 250 million. And in terms of number of investors, no more than 30 qualified investors, not more than 15 of which can be funds. There are various views on what that means, but we can talk about that at a different time. There's also a base capital requirement that applies to RFMC and LFMCs. And there are directors, CEOs, representatives, these requirements. And for LFMCs and RFMCs, there is a relevant experience requirement also, that's 5 years. Generally, like I mentioned earlier, it takes a bit of time to process, typically about 4 months if you're lucky. I think on average 5 to 6 months. Maybe slightly longer for LFMCs. For retail LFMCs, that would definitely take a lot more time. In terms of VCFM, it's actually a fairly new regime that was introduced a couple of years ago to facilitate or rather shorten the time to market for venture capital fund managers. So the licensing process itself takes a lot shorter. And as well as there are no qualitative requirements or quantitative requirements like the base capital, as well as the 5 years experience requirements. So but obviously, there are certain restrictions that apply to the VCFM regime. For example, there are certain restrictions that are imposed on the type of investments that you can make. And companies should be private companies rather than public companies. So with that as the background, there are a couple of fund structures that are available in Singapore. Generally speaking, 4 of them. The unit trust, which is mostly utilized by retail funds. The private limited has been around for a while, right? But it's mostly, there are challenges with private limited structures, which is why things like the limited partnership and the variable capital company were introduced. The LPGP structure has been traditionally utilized for closed-end funds, more private equity and venture capital funds. And most recently, the VCC, it's meant to be quite a flexible structure that can be adopted by any type of fund. What we've seen in practice is at the earlier stage, most of the funds that were setting up VCCs were open-ended funds. Now we are seeing a lot of closed-end funds slowly adopting the structure as well. There are some challenges to that. We can go through that later, as well as multi-family offices and other funkier sort of structures, fund structures have been utilizing the VCCs as well. So basically, what is a VCC, right? The VCC Act, as I mentioned earlier, came into effect last year in 2020, January. And as the name suggests, it's a collective investment scheme structure that is able to vary its capital in a relatively flexible manner. So what that entails is basically no shareholders' approval are required, to issue shares. no solvency test requirement applies in the case of a capital reduction. So, and I guess an extension of that is you can also pay dividends out of capital, right? So which makes it a fairly flexible structure. It can take two forms, generally speaking. One is a standalone structure and the umbrella structure, which basically means that you can create multiple sub-funds under an umbrella structure while still retaining a single entity structure. And so I guess to me personally, the defining feature of the VCC is that of scalability, right, and flexibility. I guess if you set it up right as an umbrella structure, it can be fairly scalable in terms of the documentation, right? So that really helps to shorten the time to market as well as the cost of setting up a subsequent sub-fund. So some of the features of the VCC, a lot of these things, I think a lot of people are very familiar with already. Dividends can be paid out of capital, shares can be redeemed out of capital. The privacy factor is in the register of shareholders where it's not accessible to the public. Shares also can be, it's quite flexible in the sense that the shares of the VCC can also be listed on a securities exchange. I think the first one in Singapore was CSOP that was listed on the SGX last year. Also, quite commonly seen, and we've been involved in a couple of these things, are the tokenization of the participating shares of the fund itself and listing that on one of the tokens exchange, securities tokens exchange, for example, ADX or iStocks. VCCs can also issue debentures. We've been involved in a couple of these as well. And these debentures can also be listed on the SGX, and we're involved in the first one that's going to be listed on the SGX. Also, I guess there's an ability for existing structures that are based outside of Singapore to re-domicile into Singapore as a VCC. But these structures have to be sort of structurally similar to the VCC in order for that to happen. What we've seen in practice, though, I think the re-domiciliation mechanism has been not so commonly utilized. More often than not, we would encourage our clients to effect it indirectly by setting up a VCC here and doing a share transfer and in specie subscription of the investors in the offshore sort of structure. The reason for that, I guess, is because you can control the timing a little bit more. But obviously, it really depends on the type of assets that the fund has invested in. For a real estate fund, for example, we most certainly wouldn't recommend that because of tax stamp duty implications. But for publicly listed securities other than Hong Kong, typically there isn't stamp duty. So doing an asset transfer can be a lot faster because you don't have to be at the mercy of the offshore authorities in terms of cooperating with the redom application. And this, I guess, is the main feature of the VCC. In an umbrella structure, the assets and liabilities of every sub-fund is segregated from those of the VCC itself, as well as every other sub-fund that's under the VCC. And because you can create multiple sub-funds within an umbrella structure, what you can also use the VCC for is to have the master feeder structure within the VCC itself. That helps to sort of flatten the multi-tiered structures that are quite common in the funds space. One question that's often asked is whether I can do that for a US feeder within a VCC master fund, or rather a VCC, umbrella VCC, and having the master as a separate sub-fund. And so the US feeder would then feed into the other sub-fund. I guess it's possible, but if you want to tick the box, what we understand is that happens at the umbrella level, which then makes all of the sub-funds ticked. So whether that achieves the purpose of having a feeder, I guess is something that you have to think about. Then there are also tax incentives that apply to the VCC because it's a body corporate. So 13X, 13R especially applies to the VCC. 13X, 13R, I guess we can cover the differences later, but there's also 13H, which is a bit less common in the VCC space. Lastly, the sub-funds can be rounded up separately. So the next slide is on the requirements and limitations of the VCC. Firstly, the most important requirement or the prerequisite to setting up a VCC is for there to be a manager that's regulated by the MAS. What this means is either an LFMC, RFMC, VCFM, or an exempt manager like a bank. The VCC incorporation process also, in terms of practical challenges, if you're one of the licensing candidates and you're waiting for the license to be approved, getting AIP from approval in principle from the MAS wouldn't allow you to kickstart the incorporation process of the VCC. It used to be in the past that it took about 2 months for incorporation to be done. I think recent times it's come down quite a fair bit to about, in our experience at least, slightly under 2 weeks. So you can only kickstart that incorporation process when the license is fully approved or finally approved. That's because I guess in the application itself, you need to list the manager or identify the manager. Then I guess the next point is a feature, but at the same time, to me, I think in certain circumstances, like in the case of closed-end funds, it's actually a limitation. So shares have to be issued as well as redeemed at proportionate NAV per share. So practically what an example of where this might be a challenge is if you imagine a closed-end fund where some of the investors that are investors in the fund get taxed differently, whether or not depending on whether you do a redemption or a dividend. So in some jurisdictions, the redemptions are seen as cap gains and that's taxed at a lower rate, and they may require you to redemption. And at the end of the fund life, if you have a carry class, for example, or even a default investor class, then obviously having shares redeemed at proportionate NAV per share without an appropriate formula for it would pose certain challenges, structural challenges, if you can imagine. I'm sure you can imagine why. Then I guess the next point also is quite an often gripe in the industry, where because there's a requirement to prepare consolidated financial statements at the VCC umbrella level, and there is a requirement under the VCC Act for the fund, the VCC, to provide deconsolidated financial statements to all of the investors in every sub-fund. I guess, as you might be able to imagine, that can be a challenge from a privacy standpoint. I don't think this point is insurmountable. There are ways to sort of work around it if you read the Act properly. So I think it's not so big an issue. The next point, I guess, is every sub-fund has to satisfy the definition of a CIS, which just without looking at Section 2 of the SFA, by definition means at least 2 investors. That's how you get collectivity, right? So I guess what the practical implication is that for single family offices, using a sub-fund as an SFO is challenging. I know people out there in the market say that it's possible, but having spoken to the regulators and looking at the consultation, looking at the requirements, and MAS themselves coming out to say that they're considering allowing SFOs to utilize the VCC, suggests that by default it's something that's still not possible at this juncture. To me, I wouldn't say it's impossible. It really depends on the individual circumstances and how you structure it. So if you ask whether you can use the SFO for the VCC for an SFO, I guess depends. Certain asset classes also may have certain limitations. For example, if you set up a crypto fund using a VCC or any structure for that matter, and you try to do in-specie subscriptions, I think that's generally a no-no. Other asset classes don't have this issue, just crypto. And I guess the last one is sub-funds must adopt the same accounting standards, which kind of dilutes the flexibility proposition. Just a quick overview on the process. I guess, after you've appointed all your various service providers, legal counsel, tax advisors, fund administrator, CorpSec, audit, you can do it later, but the rest are probably quite critical to appoint upfront. The first thing you would do is get your CorpSec to reserve the name. But some people have reserved it themselves and then ask the CorpSec to do the incorporation. Generally, just get the CorpSec to do everything because there are some issues with the system when you try to do it with 2 different people. Typically, as I mentioned earlier, incorporating the VCC takes about 2 weeks. During this time, you should have your constitution signed already because you need that to incorporate the VCC. Then once the VCC incorporation process is initiated, you can do the rest of the documentation, the fund management agreement, the offering documents, sign out concurrently. Once the VCC incorporated, you can register the sub-fund. That's almost instant these days. And then thereafter, if you have your offering documents in quite a fairly good shape, depending on which bank you work with, you can probably start to initiate the bank account opening process. I guess this is more of a little bit of a wild card because depending on which bank you work with, that can take different times. And also, I guess, due to certain things that have happened in the market in the last 1 or 2 years, the bank KYC, bank account opening process has gotten a little bit more stringent. We've seen, instances where account opening requests have been rejected, and you'll never know why. And lastly, I guess before you commence trading, you would apply for the tax incentive, whether it's 13X or 13R. That typically takes about a week for MAS to open the account, and then you go online and lodge it, or rather apply it through the MASnet portal. And then once you've applied, generally speaking, you can start trading. You don't have to wait for the approval to be forthcoming. So high level on the applicable tax incentives, I'll just talk about X and R since these are more common. The key difference really, basically what X and R does is it zeroizes the income tax of the fund itself, right? Not the manager, the fund. Basically, the key difference is, I guess, 13X has a AUM requirement, that's 50 million. 13R doesn't, but both of them have a $200,000 spend requirement. Annual business expenditure of 200K for 13R. Annual local business expenditure of 200K for 13X. Yeah, but in general, the benefits are roughly the same. I guess the key shortcoming of 13R is that there are certain restrictions on the type of investors that you can have. So generally speaking, it's a bit more nuanced, but generally speaking, 30 to 50% of the fund the entire fund shouldn't be held by a Singapore corporate investor. Also, I guess I forgot to mention earlier, one of the key benefits of the umbrella structure is that the 13X and R requirements are applied at the umbrella level. So what that means is that if you imagine you had 3 funds on a standalone basis and you had 13R or X for each and every one of them, the total amount of expenditure on an annual basis would be 600K. If you had 3 sub-funds within an umbrella structure, the total expenditure on an annual basis is still 200K. So there's some form of economies of scale over there. And now on to my last slide. The MAS grant scheme for the VCC was introduced at the same time when the structure was launched in January last year, primarily to encourage or drive the adoption rate. I guess that has been quite successful to a large extent. As of, I guess, last week, there are about 400 VCCs in Singapore. We've set up about maybe 50, 60, I've lost count, but thereabouts VCCs. So I think the grant scheme has really helped to fuel the adoption rate. What it really does is covers 70% of all qualifying expenses, your legal fees, your tax advisory fees, your fund admin fees to the extent that it pertains to setup or formation of the fund, as well as the corporate secretarial services to the extent that it pertains to the formation of the fund. You can also get the compliance fees covered if for example, you're drafting a compliance manual for the VCC, which is probably going to be the same as the manager. Each license holder or RFMC can apply for up to 3 grants. You can have as many VCCs as you want, but you can only apply for 3 grants. And there's a cap of 150,000. So basically, what that means is that the max you can spend is $214,800, and you get back 150,000. Generally, it takes about, in the past, it took about 2 months, but I guess sometime this year between February and July to June, the MAS held off on all the applications. I think they were trying to change their terms or something like that. So right now, if you ask me how long it takes, I don't know, but I guess probably 2 to 3 months. And lastly, I guess it expires on the 15th of January, 2023. So if you are looking to set up the VCC, you should bear that in mind. With that, I guess, If you have further questions, my email and my mobile is there. And I'll hand over to the next speaker.
Awesome, Brendan. I really appreciate the presentation, and we've had a couple of questions come in, but we'll perhaps keep it till the end, which are probably related closer to what you're doing. So essentially the next speaker that we've got is Dr. Stephen Fisher from First Degree Global Asset Management. Stephen will be discussing what a fund platform is. And for many of you who may not be aware, I mean, a fund platform is just an alternative. Essentially, if you're looking to, let's say, not get your own license, you can actually use a fund platform in Singapore, and they take care of all of your back office, middle office, licensing operations for you. So it is an alternative to getting your own license. And Stephen has, worked at JP Morgan for many years. He's been a fund manager himself, so he brings a very different perspective from a fund manager side as well. So Stephen, the floor is yours.
Thank you, Omar. I'll just share my screen. Yes, good morning, everybody. Thank you for joining. I hope you are going to enjoy this presentation. I'm going to talk about my personal experience in starting a fund in Singapore. I am a portfolio manager, and the basic rule of managing money for a third party, as you've just heard from Brandon, is that you have to have a license. And a manager platform is one way to get a license. My experience, which I will go through in a moment, led me to start my own platform for managers to join and take advantage of, because the process is really difficult. And a platform makes it a lot easier. So let me give you some background to how I started my journey. I was sitting in a restaurant in November 2010 with a couple of friends, and we, post GFC, we were marveling at how the hedge fund community had managed to emerge largely unscathed from the crisis that had preceded us. I've been working with JP Morgan for a long time. I wanted to change, and I sort of said, let's start a hedge fund. And I think this is a way a lot of managers approach their move from a large fund to their own operation. But it involves a lot more than you might think. How do you start a hedge fund? If you're a portfolio manager, you think, well, I'm going to be managing money. I need an investment strategy. I need trading. I need risk management, all those things that you're used to when it comes to managing money in a big firm. What you don't think are the realities of running a business. What license do I need? How do I engage with the MAS, who is the regulator? How do I qualify for 13X, 13R, tax exemption, there's 13H and 13, all these other ones that Brandon just spoke about. Cayman, BVI, Luxembourg, Singapore. What sort of accounting package should I buy? Who should be my auditor, my administrator, my lawyer, my accountant? These are questions that you don't think about when you're a manager starting your business, but they are realities. And I tell you, they will absorb your time and your money. In January 2011, I decided to leave JP Morgan. And I had one of the most pivotal conversations of my life, up there with proposal for marriage, perhaps. But it was a very important conversation when I met Tony Morgan. Now, I had worked with Tony Morgan for 10 years, but I really didn't know what he did. And he really didn't know what I did. And he rang me up one day from London. It happened to be bonus day. He told me that he had not fared as well as he had liked for his bonus, and he was leaving the company. I confided with him as well that I had decided to leave the company as well. And that conversation spawned a partnership between him and myself, which formed First Degree global asset management. Now, if you look at who we are, our qualifications, my qualifications are very quantitative. Like I'm a mathematician. Tony's a lawyer, he's a poet, okay? He has different skills that are very important to running the asset management business that we have than I do. And so together we made a very good team.
Stephen, sorry to interrupt. Is it possible to enlarge in your presentation? I think a lot of the audience is struggling to see it a little bit. Is that full screen mode by
That's
any chance?
full screen, yeah. I was in full flight. Let's see.
Apologies.
No problem. You want it bigger?
I think you just got to share the screen.
Is that better?
A little bit too big. I think it's cutting off. Okay. I guess what we can do, everyone, is I can send across the slides afterwards if you can't see it.
Well, shall I continue?
Yeah, sure, please.
Okay. Let me. I won't reference the slides too much, but you know, the point I want to make is that portfolio managers do not really have any idea of what's involved in running a fund management business. If you decide to do it yourself, you have to obtain and maintain a license. Obtaining a license can take 6, 12 months or longer. Maintaining a license is constantly being updating the MAS on questionnaires that come about your funds under management, your activities. You need a compliance function. You need a business manager. There are actually multiple regulators you have to deal with. And the headcount, minimum headcount that you need is at least 3 people. If you join a platform, then you can actually tap the experts that are available, and you can start almost immediately to manage money. You can save your time and your money in that process. I think the next slide, I hope you can see, it's just an org chart, but what joining a platform enables you to do is to harness and exploit an existing structure. If you walk in to raise money and you put up a picture like this, where you have Chief Executive Officer who has legal and compliance background, Chief Investment Officer with 20 years, 30 years experience in managing money, public markets, private markets, 7 portfolio managers with different skills, administration, private wealth operations, all these people. It gives you an advantage in terms of showing your investors that you have a well thought out support strategy, support network for your operation. Now, my final point I will make is at what time should you start planning for your launch and your to build your strategy, to build your structure, to take advantage, to maybe get your license. And what I tell investors is, before you build a fund, you have to find investors. A lot of portfolio managers leave a big firm and they think they have to start a fund. The fund can start later. What you need is investors. So 12 months beforehand, you start finding investors. 10 months, you keep looking for investors, keep finding investors. And throughout that early period, when you're looking for investors, you can sort of cultivate some sort of dialogue with a platform like ourselves. but there's no need to start building until you find an investor. At that point, it's really useful to spec out the structure that you want without actually starting the fund, just starting, get an idea of what you need. When your investor confirms that he wants to fund your operation, then you can build it and launch it. The actual building and launching only takes about 6 to 8 weeks. The hardest part is actually raising money. And I think that's a message that you should take from the presentation. With that, I thank you very much for your attention, and I will hand you back to Omar.
Sure, thanks, Stephen, for the presentation. Just a couple of quick questions since we've got a bit of time. Stuart was asking, what license does First Degree have in Singapore?
We have a CMS license from the MAS for accredited investors only. It's one step short of the full retail license, but retail licenses, you find it very difficult to be on a platform. Retail licenses tend to be for banks like DBS and OCBC to offer to their clients.
Awesome. Thanks, Stephen. I think we've had a few more questions, but we'll keep them for the panel discussion. So really appreciate you sharing the presentation with us. All right. So before I introduce the next speaker, I'm just sharing the poll results that we had at the beginning of this presentation. Have you currently set up a VCC? So I think a lot of the audience has not set up a VCC, but they are considering. So I think the next speaker I think is very valid in terms of walking us through the whole licensing process, items that you should be considering when you're running compliance as a registered fund management firm. So with that being said, I'd like to introduce the principal of Principium Consulting, Damayanti Shahani, to explain to us a bit on, let's say, the licensing application process, ongoing compliance that you need to consider when you're setting up your fund management business here in Singapore. So Damayanti, the floor is yours.
Thank you, Omar. Great to be here this morning. Good morning, everyone. I think it's good to sort of come in the middle, because I've had the advantage of both Brandon and Stephen sort of laying the groundwork on what it means to run a fund management business out of Singapore. Let me just share screen, and then we'll be on our way. Can you see this already?
Perfect.
Let's see how I can get this going. Okay, so I guess I'm going to discuss the L word, licensing, and what that really means, right? The whole process of getting the MAS license and what life means after that, because once you have that license, there is an ongoing regulated life that you need to sort of think about. My firm, Principium Consulting, we focus on the fund management, capital market intermediaries, and we've been assisting them with obtaining licenses, with getting their compliance policies and procedures put in place, and then with ongoing day-to-day support as well. So I'm going to sort of take you through the fund management landscape in Singapore, and then we'll talk through the MAS licensing triggers and the ongoing compliance requirements that you need to be thinking about if you're setting up a fund management business in Singapore. Now, like Brandon said at the beginning, it's a gating item for you to think through when you are looking at managing a VCC. And the gating item is that you need to have a licensed or registered fund management company in Singapore, or a duly exempt company in Singapore that is eligible to manage that VCC. So it really is very much part of that initial decision-making process as to whether you're going to go and get that license on your own, or whether you're going to use a platform such as First Degree in order to kick off, literally. So this slide, which comes from publicly available information that the MAS put out last in 2020, and I think you'll get the update for this year, shows you how the number of fund management companies in Singapore has only just increased over the last few years, as has assets under management. We've seen this across strategies, whether they're closed or open, retail or accredited institutional only. And we've also seen this in terms of, the growth in terms of the vehicles being used. And clearly the VCC having come in last year has been a huge addition, increasing Singapore's strategic advantage, because you can co-locate both your manager as well as your investment vehicle here, as mentioned earlier too. So as we sort of delve into the MAS licensing triggers, the thing to keep in mind is that it is essential for you to be conducting substantive fund management activities in Singapore in order to even qualify from the MAS's perspective to be a licensed candidate. And when I say substantive fund management activity in Singapore, just as a few examples, that would be activities such as portfolio management, investment research, trade execution, etc. If you're only raising funds for an operating company or just a conduit for structuring units in a fund, that will unlikely rise to the level of allowing the MAS to grant you a license. So it's essential to make sure that there is control over the portfolio, you're exercising influence, etc. And I would assume the audience that's looking at setting up a VCC here is already thinking along those lines. Another thing to keep in mind is you are looking at managing third-party monies, just to put it very simplistically, in order to be a license or a potential license candidate. And therefore, typically, single-family offices, for instance, are not eligible candidates for a license. But as again, one of the previous speakers said, the MAS is considering making them eligible for VCC management as well, perhaps in the near future. Brandon did take you through this, so I'll just very quickly revise this from the perspective of a compliance lens, and that is the types of fund management companies that are available in Singapore for you to consider if that suits and fits your business model. The licensed fund management company, which sits under the capital market services license category, that the MAS sort of terms them as such, or that's the phrase used for them. These are divided into three, where you have the retail, no caps of any kind at all, neither in terms of nature of client, nor in terms of AUM, number of investors. The LFMC that caters only to accredited institutional investors. Clearly, as the name suggests, you can only deal with qualified investors here. And then the VCFM, or the venture capital, that is restricted even in terms of its investment pool. Typically speaking, at least 80% of committed capital has to go into unlisted ventures that are no more than 10 years old. And then there is another bucket, the RFMC, which is not exempt. It is indeed regulated, but with a slightly, and I emphasize the word slightly, lighter touch than the LFMC. But here you are limited in terms of AUM, no more than SGD 250 million, and in terms of your number of clients and qualified clients, again, no more than 30, within which no more than 15 can be funds like the VCC. Now, licensing criteria, it's important to sort of go through this, practically before you dive into the licensing process, because remember, that is going to take your resources, your time. So you want to make sure that it is set up to succeed and you don't sort of end up with a rejection. The MAS does put out in the public domain, again, reasons why it has rejected. And it tends to be, or rather why it has rejected X number or X percentage of the license applications over the last year. And the issues that it throws out there tend to be, that the talent pool, the CEO, the directors, the relevant professionals, etc., didn't have adequate background, relevant experience. It tends to be topics such as, lack of substantive fund management that throws an application out. So it's important to keep that in mind. And here is a snapshot of the licensing criteria that's sort of binding from the MAS's perspective. Starting out with the need for some regulatory capital. You will need to maintain base capital, which will vary depending on the type of license. There you have it in respect of RFMCs and LFMCs, catering only to accredited institutional investors. It's no more than 250, or it's at least 250,000 SGD. For retail, it increases. And if you sort of tick down that list, you'll see, in addition, there's a requirement for an office. The fund management company has to have a Singapore incorporated entity with a physical office in Singapore. You can choose a serviced office so long as it's locked from the perspective of safety and security and conflicts of interest. And then you have a bit of a write-up over there on the talent pool. And if I was to sort of just whittle this down into the RFMC and LFMC AI category for now, if the criteria that I'm going to describe are met, you need to start with literally just 2 persons. But keep in mind the workload. And if that's not something the 2 can manage, even with outsourced service providers, you may need to look for 3 or more. For retail, the minimum number is always going to be 3. Now, with that in mind, just note that you need to have a resident executive director, a resident CEO. You also need another director, that may be a non-executive director, and you need a minimum of 2 relevant professionals and representatives, i.e. those who are involved in the day-to-day activities and those who are in the front office. All these individuals need to have relevant experience. And in the case of the CEO, that would also include, supervisory and managerial experience from the past. So this is a very important thing to evaluate before you go down the licensing path, because it is one of the reasons the MAS tosses out applications. And as I said, you don't want to waste your time going that far. Moving on to the next slide, compliance arrangements. There is some flexibility if you're an RFMC and LFMC AI that's managing monies less than 1 billion SGD. Above that, you do need a dedicated independent compliance function in Singapore that may perform complementary functions such as in-house legal. But even so, there are service providers, and this might sound self-serving, but me and my competitors who do provide outsourcing compliance assistant when you can have it at the RFMC and LFMC AI level. Licensing criteria, when the MAS looks at your application, of course, they will look at your business model. What's your plan? What are your projections? What are you really expecting to do in Singapore? Are you looking to start the fund management business within 6 months of the license, or is that looking unlikely? Because you are supposed to kick off in 6 months, although I think there has been some flexibility in this pandemic environment when people have found it hard to fly to locations where potential investors are. And also they will look at your internal risk management compliance systems, your ability to sort of carry on, not just at the time of licensing, but into the years to come. With that said, a little bit on perhaps the licensing process, and then I'll dive into at a high level your life after licensing, which is a regulated life. So the licensing process requires you to fill up certain licensing application forms and accompanying documents, including a well-drafted business plan. All this is going to play a role in the MAS's lens as it views your application process, and also the initial impression it has of you as a regulator into your life as a regulated entity. The application process, applications when submitted, typically the MAS will come back with a bunch of Q&A, and that process at a minimum will take anything between, I would say, about 4 months these days to 5 months. And as I think Brandon again pointed out, that could be a longer period depending on the license category. So give yourself a buffer of time, maybe six months or so to sort of get to the other side, which is the licensed side. Now, once you're up and running as a licensee or a registered fund management company, you have to be very cognizant of the fact that there's a bunch of regulatory instruments out there that will apply to you in daily life. And that is your ongoing compliance program. These are issued in various forms by the MAS. Some are legally binding with criminal and civil implications. Some are guidelines and best standards. It is a fairly nuanced area, and increasingly nuanced, as well as increasingly mobile, dynamic. You have changes, you have upgrades to these rules all the time. But here you have a snapshot again at a very high level of some of the things you need to think about post-licensing as well. And post-licensing is very immediate, right? It's the moment you're licensed. So from regulatory capital to the need to have an arrangement with external service providers for both external and internal audit, independent custody, unless you're a closed-ended fund for the assets where you can self-custodize, valuation reporting, which has to also be independent, risk management compliance, which depending on your size can be internal or supported from the outside, and an ongoing system where you're managing conflicts of interest, including, for instance, personal account dealing, a strong anti-money laundering program. Remember, the MAS in Singapore have signed up to the Financial Action Task Force, or FATF standards, which takes us at a level of rules that are very risk-based. So that's good news. It depends on the client in front of you, but also equally need to be there in place on an ongoing basis, among other requirements. Keep in mind that you will need to have other service providers as well. The external audit is mandatory, and you will have to file your external audit report with the MAS every year within 5 months of fiscal year end. But the good thing about Singapore is that there are plenty of service providers out there whom you can choose from, very sophisticated, very learned in this area. So you will get whom you need in order to continue your life as a regulated entity post-licensing. Just a snapshot again of also the requirement for an ongoing interaction with the MAS once you're licensed. Some of it is in the form of hard-coded filing obligations, whether it's around your financials or around changes in your staffing and talent, or around misconduct, changes in corporate events, like you're buying up you're establishing a branch, or you're being bought into, things like that, depending on your license category. And overall, the MAS continues to interact with you, even in the form of surveys and perhaps email questions from time to time. I will be sort of cognizant of time here, and I won't spend too much time on this, but I think the aim is to also just sort of prepare you for the fact that when you're thinking through the entire VCC structure, you need to also be considering the criteria you need to meet in order to have a successful licensing application process at the manager level, and also that you're ready quite soon to be continuing your life as a regulated entity with an ongoing compliance program, policies, and procedures. So with that said, very happy to take questions when Omar gives me the cue, and I'll pass it right back to Omar for the next speaker.
Sure. Thanks, Damayanti. I think we'll just take a quick question because the questions are building up. So one for you. If a manager sets up a fund in Cayman, which will invest in Singapore, and also sets up a manager in Singapore to manage the Singapore investment, would a license be required in Singapore?
Yeah. So I think whenever you're thinking about whether I need a license or not, think activity and think location. So if the portfolio managers, if, execution, just to sort of give you a few examples, if fund management activities are happening from Singapore, it's the activity that drives the licensing decision. And so if any of these things, just as examples, are occurring from within the shores of Singapore, yes, you are a candidate for licensing. You cannot conduct those activities without either a relevant license or being duly exempt. So I want to connect it to the activity, and hopefully that makes it easier for the audience as they're thinking through their decision.
Perfect. Thank you, Damayanti. I think we'll keep the other questions for later, just in the interest of time, but really appreciate that insightful presentation. Excellent. All right. So I guess on to the next speaker. Essentially, as many of you know, I chair ASCENT, which is a fund administrator based here in Singapore. And we currently administer a lot of the new VCC structures. So we've got our head of hedge funds, One Thing, giving a presentation essentially on the importance of fund administration. And we've had a few questions coming in. One Thing also from one of the audience asking, is fund admin a must for VCC, or can one handle it in-house? So maybe throughout your presentation, you can address that, but I'll leave the floor to yourself.
Thanks, Omar. Hi, good morning, and thanks for joining this session. So let me just share my screen to start off. Okay, so essentially I'm going to cover on why a fund administrator is actually required. Okay, so what is actually fund administration? So it's actually an outsource of support functions, typically comprising of two main parts: the fund accounting and activities of the registrar and transfer agency. So fund administrators are often specialized in specific investment types, broadly in hedge funds, private equities, real estate infrastructures, venture capital, family offices. So with this specialization, fund administrators can help with setting the funds correctly from both financial and legal perspectives. They do your back office administrative work and financial paperwork, and hence this also helps you minimize risk and optimize governance and control. So the services that the fund administrator typically provides, I have categorized them in several categories for ease of reference. So for the fund accounting, typically as part of the accounting, the trades will be captured and such other related activities. The administrator will have access to their own pricing mechanism, and they will be able to price your listed exchange traded securities as well. And then we verify and record incomes, accruals, and expenses, including your interest, your dividends. And the most important is calculating the net asset value of the fund, determining the fund manager's fees, such as your management fees, performance fee, carried interest, So in a way, you bypass the conflict of interest of calculating your own fees. Then we will also maintain the books of the fund in accordance with the fund's governing documents, as well as the relevant accounting framework that is being adopted. So the few common frameworks that are commonly used are the Singapore Fund Reporting Standards, International Financial Reporting Standards, and the US GAAP. And just for your information, VCCs are allowed to adopt either of these frameworks. And then in the next category, it's the treasury. So administrators generally will be able to assist you with payment services to facilitate your cash transfers, make payments for fund expenses, including payments of remunerations to fund managers. In terms of the control of the bank account, it can be held by the fund administrators, or it can be like a joint account, joint mandate, which will create a better governance. So in the next category, transfer agency. So administrators process your issuance of interest shares to investors, facilitate transfers and redemptions. They maintain the registers, as well as they assist with your investors' queries and providing periodic statements to investors. But most importantly is in the ML CFT aspects, as the Damayanti has discussed on in the previous slides. In Singapore, fund managers and also the VCC structure are each subjected to the provision of MAS AML notices. So fund administrators can actually assist funds and fund managers in the performance of customer due diligence. So they will usually have already have the relevant procedures and resources in place to meet these regulatory requirements, particularly in the identification and verification of customers, the screening against sanctions and non-compliance jurisdiction lists, and then they can help you perform ongoing monitoring, transactions monitoring, and also periodic screening to identify any changes in risk. In the next category over here is on your tax reporting services. So the fund as a general in Singapore will be subjected to US FATCA reporting and CRS reporting. So this service can actually be provided by the fund administrator to perform the required due diligence on investors and perform the reporting at the end of each year. And then, of course, subjected to the relevant conditions for income tax concession, the fund can claim GST incurred on expenses related to the fund investment activities. So fund administrator can actually help you to compute the GST remission amount and also to do the appropriate claim back on the GST. Other services that the fund administrator may provide is to help you prepare K1 or PFIC statements for your investors, and also other investors reporting such as ILPA. So when you are setting up a fund, so some of the considerations that your fund administrators can help to guide you along, I have set them out in this slide. So getting your fund administrator involved in the review of offering documents will help to ensure that it's legally and operationally sound. So such as your offering terms, including the subscription and redemption terms, the practicality of the dealing deadlines, the equalizations that you see in the closed-end funds. Structurally wise, to consider in terms of investment strategy, whether an open or closed-end structures could be more suitable, whether you may need funds like master feeder structures to actually segregate your taxable and tax-exempt capital, and offering of different share classes to accommodate different terms for investors. And also on this, for example, your side pocket because you have illiquidity or hard to value assets. Your administrators will have their own way of doing valuations, and they can actually, because it's a common set of market standards. So that could also help you with doing up your valuation policy for the fund and ensure it's in accordance with the relevant accounting framework as the market standards. In terms of the manager's fees, particularly for performance fee, you see your equalization accounting versus your series accounting. So your administrators are familiar with this type of structures, and then they will be able to advise you on that. Okay. Then the other aspects are like your distribution, how you're going to do the distribution to your investors, if you're going to pay out dividend out of income, or your distribution may be out of capital, as mentioned by Brandon earlier. Your fund administrators will be able to help you to apply for your GIN for FATCA purposes, as well as also help to register your Singapore funds with the IRAS for the CRS registration. Then in terms of the bank and custody account, so your fund administrator will be able to assist you in the bank account opening, which they will be much more familiar and ease up the process. So the other aspects on when setting up is whether you actually need identifiers for your funds, such as your ASCENT or the Bloomberg ID. Okay, so coming to the last slide. So what are some of the benefits of outsourcing to a fund administrator? Okay, so the first point being the independence. Having a fund administrator adds a layer of review and independence, since fund administrators have robust controls and generally have their processes undergo a SOC audit. There is an increase in sophisticated and institutional investors demanding for independent fund administrators as well. Fund managers can be more focused on their core activities, such as tradings, assessment of investments, raising capitals, and not be weighed down by administrative matters and regulatory reportings. Technical expertise-wise, fund administrators are well versed with the relevant fund operations and asset classes. So a fund administrator with the requisite skills, expertise, and resources will work alongside with the fund managers and ensure that the operation and fund remains compliant. Leveraging on the fund administrators' technology. So fund administrators, they have their own systems that they use to perform your fund accounting as well as AML requirements. For a specialized accounting system, they are actually costly, and not only due to your vendor costs, but also the time and other costs to support the use and training of such systems. So if you rely on the fund administrators because of the outsource of the functions, then you can actually cut back on all those additional costs that you may have to incur in-house. And more importantly, for small fund managers, you may start up small, or new fund managers in general. You may not have that number of staff and sufficient technical expertise and also infrastructures. So that's when you have all this middle and back end services, middle and back end work being outsourced to the fund administrators. That will actually help you a lot in your progression. Okay, so to the last point, where there's a question on whether fund admin is a must for VCC or can be handled in-house. So while there is no requirement to appoint Singapore-based fund administrators to the VCC, it is a criteria under the tax incentive scheme to be qualified. So yes, to enjoy the tax incentive, then you have to appoint a Singapore-based fund administrator. So I hope this answered that question. And back to you, Omar.
Awesome, One Thing. Thanks for answering the question, and a great presentation. If anyone wants to reach out, One Thing has her details on screen as well. So thanks again. And I guess on to our next presenter. So the next presentation will be on prime brokerage and what it is. And I guess this is probably more relevant for the hedge funds here that are attending. And we've got the head of prime brokerage sales, Mark Lang, giving a presentation on that. I've known Mark for quite a while, and they have a very good solution for a lot of the small, mid-sized fund managers here in Southeast Asia, and getting quite a bit of interest on their offering. So Mark, I'll leave it to you, mate.
Yeah, thank you for the introduction, Omar. So morning, everyone. my role as prime brokerage sales in Maybank is basically an originator. I work with managers whose AUM starts from 10 million all the way up to under 100 million. What I do daily is I speak to family officers, wealth advisors, asset managers, and service providers and talk about ways, firstly, one, Maybank can help them grow their business, and two, how we can help them solve solution gaps that they might be experiencing. So I just want to use the next 10 minutes to share my insights on what a startup manager might need to know about Prime. So let's start by defining what's a prime broker. So a prime broker can be defined, it is normally an investment bank or a securities dealer. There's an entire spectrum of prime brokers that caters to the needs of fund managers depending on their size, their strategy and needs. On one hand, you have the large investment banks, the likes of Goldman's, that offer a comprehensive product and service solution, but focus on larger mandates. And on the other hand, you have local securities brokers that may just offer a synthetic swap product. The business itself, prime brokerage, really refers to a bundled package of services offered to asset managers. And if I had to sum it up, there's 6 core functions of prime. The first one is obviously execution and trading. Then you have the custodian or global custody facilities. Next, you have securities lending, especially for long-short managers. There is a financing element. This is a key part of why you would want to have a prime. Primes also provide technology solutions. And the last thing, obviously, is primes help with the settlement support, especially if using multiple brokers. So therefore, that brings me to the next point, and it's really, do you really need a prime? If you're mainly private equity, then no. If you don't require financing or securities lending, also no. If you're going to custodize with a standalone custodian, you won't need a prime either. In such cases, securities brokerage account could easily meet your execution requirements without the need for a prime. But really where a prime broker can create value for you is through the package of services that really augment the relationship. So just to recap, I spoke about 6 core services: execution, custody, securities lending, financing, technology solutions, and lastly, settlement support. Obviously, what happens is, depending on the prime that you're speaking to, there are a range of other concierge services, and that actually can matter to your business. So some of these would be cap intro. Some primes provide risk management tools that you can utilize. Some provide fund consultancy. Some provide additional fund admin services. And last but not least, there is the cash management account solutions as well. In respect of fees, so I would categorize this as fees falling into 3 buckets. There are fees incurred as a direct result of trading, so that's mainly execution, brokerage, and market charges. And then secondly, you have, if you borrow against collateral or you run deficit in the currency, then you can expect to pay financing fees. I would group all other fees as account management fees, and this would be, a whole bunch of miscellaneous fees, from custody to account minimums to TT charges to market data, OMS, PMS system fees. Some of these fees are small, but you should be aware about them. And obviously, the topic on fees would really not be complete without us discussing how fees are determined. So most of the time, when a manager is onboarded on a prime platform, they do receive a bespoke solution that is tailored for their trading and settlement needs, the collateral that they want to post, the leverage that they're looking for, and also the amount of service support that they intend to receive. As much as the friction costs of trading and financing, have to make commercial sense to the manager when they calculate how much alpha they pay, there's a similar rationalization process that is being applied by the prime broker. In that sense, really it's important when you have that initial conversations with a prime broker that the prime is going to want to understand, firstly, they want to have an understanding of a fund's roadmap. They'll want to know when the AUM is being brought on board, when it might be increased. They'll want to know whether the book is being split between them and other prime brokers. How much financing is going to be required by the fund? What are the growth plans for the fund's AUM? And what is the composition of the book being onboarded and the frequency of trading? So this is what's going through the mind of the origination managers when they're speaking to you in respect of getting onboarded onto a platform. So before I talk about choosing the right prime, I have a rhetorical question. Have you ever speed dated before? Or maybe people use Tinder nowadays. I'll be honest, I haven't. Regardless, I envisage speed dating as an art form. So you do have to have a plan and an arsenal of smart questions to efficiently narrow down to a short list of suitable partners. And you can use this same strategy when selecting a prime or any other service provider for that matter. Ask the smart questions, ask the right questions. If you're evaluating primes, it's likely you're juggling the process of evaluating other service providers as well. Submitting your license application, securing anchor investors, all whilst trying to manage the challenges that accompany a startup. So I've asked myself, how do I do justice to a question of this nature? And after some thought, my advice is really to suggest that you don't tackle all these challenges yourselves. And really, it comes down to why we're having this webinar. The service providers in this webinar have years of experience and a pool of industry contacts. They would really have a good idea after speaking to you on the prime that would be the right fit for your mandate. So really, have that conversation with them. And also do remember to speak to other community, to the community of managers, and for their own insight and experience. Finally, before I hand over to Igor, I was asked to say a few words in respect of onboarding, so I should change my slide. There it is. The goal of onboarding for both prime sales and the manager is really keep the process as painless and as quick as possible. And I just have 4 tips to share. I don't want to make it too long. So the first one is be clear if a cash management account is required, essentially a banking account, whether for the fund or the manager. Depending on the structure of the fund, onboarding with the commercial bank can take as long or longer than onboarding with a prime. So best to start both concurrently. Tip 2. Factor in the amount of time you require for the legalities of paperwork. If speed of onboarding is crucial for you, then you probably want to identify a prime that has a static, PBA, prime brokerage agreement, versus, the back and forth negotiation of executing an ISDA. Tip 3. Onboardings require banks to know the beneficial owners. So if you have a complicated corporate ownership structure, there is a chance that the prime will need to drill down to unmask really the natural person who is the beneficial owner. And last but not least, put your requirements down on email. Be as specific as possible in respect of the markets, the products you require. In preliminary conversations with prime, the sheer amount of info that has to be communicated back and forth may really not, may clearly, result in a certain, identification of a need not clearly being identified. So really do the extra work. Summarize your needs in writing. I think that's pretty much it. Hope it was a useful session. Always happy to share my personal insights. Thank you, and over to you, Omar.
Awesome, Mark. Appreciate it. Very, very kind of you, and we'll keep those questions, I guess, till the end. So I guess on to our next presenter. So essentially we've got one of the senior consultants from Mercer, Mr. Igor Evangeli, presenting. And I'll just share results of a poll, Igor, before we get into your presentation. I was running a poll in the background saying, what is your biggest worry when you're setting up a fund? And number one was raising money. I mean, my first job in the hedge fund industry was raising money for a small hedge fund. And to be honest, I mean, we had over 100 meetings, and you know, out of 100 meetings, only one guy gave us money, and that ticket was a $100,000 ticket, even though we had institutional grade operations in place. So, you know, this is a challenge that I see a lot of my fund manager friends face day to day. And I think Igor has a very interesting perspective, given he represents some of the world's largest institutions, and he's sent out to do operational due diligence for some of the biggest pension funds within the region. So Igor, please do share some of your insight with our audience. I'll leave it to you then.
All right. Thank you very much, Omar, for having me and for the kind introduction. Yeah, just quickly a background to my team. Within Mercer, as Omar said, we serve most of the big pension funds in the world, endowments, institutional investors, your private banks or stepbots in the regions. So within the wealth business, we have a dedicated team called Mercer Sentinel, where we conduct operational consulting or operational due diligence on an investment manager in this region. And that's why we do other services like custody consulting and transition management. But for this presentation, let's focus more on the operational due diligence aspect. And kind of interesting to see also in the slide, but what's the most difficult challenge is to raise money. And I think that's also what Stephen highlighted in his presentation. And part of this process is really going through the diligence process. And the diligence process, as most of you are aware, has always two components. It's the investment due diligence aspect, which kind of focus on your alpha generation. And then you have the operational aspects, which kind of focusing on the risk and the cost of association of execution that could result in the alpha regions. So any operational risk, which could eventually lead that you maybe not get the mandate, even you're performing very highly and your performance is exceptional. Operational risk have shown statistically have failed, or operation has led to managers failing or losing mandate. And in the past 20 years, if you look at the statistic, operational risk was for 50% of the manager the main reason they didn't get this mandate or the mandate they were pitching for. And in my slides, I just want to go through some of the processes you should consider. What are the common themes? Operational diligence consultant like myself, we are looking out. So you have a better understanding how to approach this process. And yes, as also kind of highlighted in the entire process and discussion over the last hour, investments operations are getting more complex. Requirements of regulators are also kind of more stringent now, and managers have to comply with various regulations and guidelines. And clearly investors understand there are increasing complexity. Even COVID, where now everybody's working from home, certain managers had kind of to redefine the operating model. So which raise a lot of concerns for investors, and the demand for operational due diligence has also increased. An interesting fact is, where I remember when COVID started in 2020, February, there was a lot of discussion going on. Do we continue conducting operational due diligence because we can't go on-site, and on-site visits were kind of the key element. And then when we had the discussion with institutional investors, they always represent, okay, we only go with managers we know, we have seen before, or we just hold back our contribution or subscription until the COVID situation kind of disappear. But as of today, we know it didn't disappear. Sometimes it gets worse, sometimes it gets better, it fluctuates. But the market is still doing well over the last year. So investors kind of decided, okay, let's go ahead with operational diligence while we move into a virtual environment. Generally, what does it mean? My team are not able to travel across the regions. So we do everything over VC calls and had to adjust our approach and our questionnaire. And I'll walk you through a bit about that in the next slides. Just to recap, why operational diligence are also kind of important, and investors are getting more stringent about it and aware of that, because as highlighted, there has been operational failures in the past Probably the most precedent case you're aware of is the Madoff case, which have led to over 50 billion of losses for various institutional investors. As well, if you look at these days, what happened in 2020, everybody is aware of the NV case with the nickel fraud, which seems to be a lack of due diligence which have been conducted on them. If not, they should have been picked up. Or the Australian hedge fund who were kind of suffered from a cyber attack, which eventually kind of led to around $1 million losses because the CEO clicked on a phishing link, which eventually gave some of the hackers access to the bank account and the email accounts to execute some of the payments. So as you can see, investors are clearly aware of that, and operational due diligence plays a crucial part for them to assess a manager before they commit anything. And what are the typical aspects you will look for when it comes to operational due diligence? In particular, I will share from a Mercer perspective, but I believe it's a very common approach in the for other consultants as well. So when we assess managers, we always start to understand what's the governance structure, what's the segregation of duties in place, where are the reporting lines. And so focus on the regulatory compliance and audit aspect. Where's the manager licensed? What license does he hold? Who are the service providers engaged to support them in the compliance aspect? How do they have a proper compliance monitoring problem in place? Is the fund management company audited? By whom is it audited? Can we see your financial statements to understand there's been unqualified or qualified opinion? And then based on that, you will deep dive in various sections of your business, starting from human capital. When we talk about human capital, we look at the staff turnover, the qualification of people, the capabilities, as well. Particular for smaller manager, is there a key man risk? Is this key man risk reflected in your PPM? A very crucial topic these days, also technology, cybersecurity. It doesn't mean that smaller size managers don't need to comply with that. And as you can see, MAS has issued various guidelines on the cyber hygiene, which managers need to comply, in particular the licensed one. As well, from a ODD perspective, we deep dive on that aspect to understand how the manager established a proper cybersecurity strategy to address the issues or threats they're facing based on the asset class, based on the environment they deal in. As well, each proper due diligence, we walk through a transaction execution part, which means they really look at your trading process from initiation, pre-compliance checks, guidelines implementation to execution. Best execution is always a hot topic, allocation of certain securities, particularly if you run various strategy at the same time. And then we will also focus on the valuation administration aspect, how you strike your NAV, who are the service providers you use in the region, fund administrator you do it internally, what's the process on the cash control? That means, has the manager sole responsibility and full control over the cash, or does he outsource it to a fund administrator, which we consider obviously the best practice because we have an independent party be involved in that. And then on the other side, we also look at the third-party relationships, which is kind of important, the whole context, particularly for smaller manager when they engage with various service parties, how they provide oversight, how they benchmark them, is there proper KPIs, SLA in place to ensure that they meet the responsibilities, because eventually the accountability always lies with the manager. One other topic which is always important, in particular during COVID, is about business continuity and disaster recovery. So was the manager ready during COVID-19 to work from home? Particularly, everybody's working from home. I think we noticed that during that phase, yes, managers had business disaster and continuity plans in place. However, it was sometimes not the scale that everybody's going to work from home, right? The traders usually will go to the office, but what happens if the traders are not able to access the office? So all these kind of scenarios you have to go through and to discuss with the manager. And one other topic is also we look at the fund structure to understand what are the vehicles the manager is using. Is it a VCC? Is it a Cayman structure? Is there proper governance in place? Who are the fund auditors? Who are the fund administrator? How is the NAV calculated? Is the performance fees in place? Do you use serious accounting, equalization accounting to ensure equal treatment of investors? So as you can see, it's a very comprehensive framework an ODD expert has to go through. And also the manager has to kind of respond to those questions and show that he's capable and scalable to address those questions. And this is the next slide is just highlighting really where we start from when we look at the execution aspect of the ODD, and it's really starting from the investment initiation. That means when the portfolio manager passes his trade order to the trader, what is the process then, and how do you ensure that the trade is executed in line with the investment guidelines, ensure that you hit the right price, best execution, as you mentioned as well, allocation is important. And then what happened in the post-trade phase when it comes to trade confirmation, trade matching? Is it a very manual process? And then does it make sense for this manager to be very manual due to the size, or do they have hundreds of transactions every day? Then a manual process probably is a high risk area, which we need to understand. So all these aspects play an important role when you assess a manager. And in generally, when it comes to the ODD process, before that, I would really kind of highlighted the areas we look into it, but every sophisticated or good ODD process always starts with a kickoff meeting with the manager, where the ODD team will share with you, okay, this is the process, this is the documents I'm looking for, this is the timeline, can we arrange an on-site visit? And particularly also highlight what are the speakers you will represent to focus on certain areas the ODD expert want to assess. And it comes back to my previous slide, the kind of these 10 areas of governance, regulatory and compliance, valuation administration. So the manager will usually send the most senior people to represent each section, because it's important to show that you have the capabilities and skill set. After that, if this is all determined, during the meeting, particularly for Mercer, I have to say we are quite transparent. So we always kind of share with the manager what are the risk areas they have identified, what are the particular points we will raise in the report. So the manager is kind of also aware what's happening here, and is not in a kind of unclear situation. Eventually, if they don't get the mandate, or if they get the mandate, what was the reason for it? And that will happen after the report is kind of written from our side. We will arrange a feedback session where we have verbally share with the manager, okay, listen, this is your rating, this is what the areas of risk have identified, and this is what we're going to communicate to the investor. And I believe it's a common approach around the bigger organizations who conduct ODDs. It should be seen as a consultative approach, I would say. So managers also have the opportunity to take advantage of it, I would say, in asking the ODD expert, okay, what do you see in the industry, how to address this risk, what is your recommendation? And that's probably the beauty of ODD. It's paid by the investor, but you have the opportunity kind of to tap on the ODD expert skill set and experience to kind of clear some of your questions and concerns you have. Because ODDs are not here to kind of to avoid that you get the mandate. It's more helping you and the investor to kind of find a common ground to understand what are the risks within the business and how to mitigate it. And what are the common areas I see in the region? Sometimes we notify when it comes to risk. One area, yes, these days cybersecurity and network securities is always an issue at the moment, particularly when it comes to using mobile phones, access to public clouds, access to private emails, blocking USB, data protection of investors' data, or hard disk are not encrypted of laptops issued by the company. So this kind of basic issues are still exist, surprisingly, but because sometimes managers think I'm a small size manager, I don't need to consider that, but it's crucial because reputational damages, as you see with the case for the Australian hedge fund, can lead that you have to close down your fund because investors don't trust in your operational setup. Another aspect is always about the independence when it comes to the fund governance. When we look at the fund structure, the best practice is always have to have independent directors on the board. And it's also important to choose the right partners, the right directors with the right experience who can help you through the process. And you will be surprised how much difference it can make if you have the right directors on the board who have the experience, who can guide you through the process and also help you to find the right service providers, etc. And part of this process is important also when you collaborate with third-party providers, have a robust cash controls in place. How cash are moved, who approves it, is a double signature, is the fund administrator approved? Does the fund administrator is the only one who has authorized to the banking portal to execute the payment, or is it fully managed in-house? If it's done fully in-house, what does it mean in terms of your controls and segregation you have to in place? That means, does the PM able to move the entire cash himself? that obviously is a red flag. So you have to kind of outline it properly, the segregation of duties, and collaborate with the fund administrator if you appoint one. And appointing a fund administrator from our perspective is, for a hedge fund business, is a standard practice. I would say if you don't have one, it could raise certain concerns depending on your size, particularly for smaller manager, I think we would expect it. On the private side, there is a balance. Certain managers prefer to do it in-house for various reasons because of the volume of transactions is lower. However, we will always recommend also considering a fund administrator, which comes back to the point of segregation of duties. If you're a small setup and the CEO runs entirely compliance, operations, middle and back office function, and does the fund administration as well on top of that, yeah, that could raise some concern about capabilities and skill set and capacity constraints, particularly for multiple roles. Another point which we always noted for smaller firm, mid-tier firms as well is about keyman clauses and succession planning. So what happened to the founder if he is incapacitated and not able to continue run the business? Is the right keyman clause within the PPM? Yes, most of the time it is, because advised by proper legal counsels, they will usually clearly highlight that. Secondly, what happened to the equity control? And this is sometimes very underestimated point by a lot of managers. Will the family take control over the firm, or will it shut down? So this needs to be clearly documented and outlined so investors understand that the firm has thought about it. And then as well, now a hot topic is always about hybrid funds who traditionally did public investments, but now moving into the private side, means through side pockets or setting up private equity funds by himself as a separate vehicle. So that always creates a lot of concern because you need to represent that you have a clear policy and clear controls in place to segregate private and public, to avoid any non-public information fed from private to public. And as well, the processes can vary, the valuation approach can vary. The liquidity is always a big issue because if you have a monthly hedge fund and you have a private equity investment, how do you ensure the liquidity is still matched, right? Private equities cannot be sold that easily. It's rather illiquid investments. So as you can see, there's a common topics we usually see in the regions, which needs to be addressed by certain managers and which can lead to high risk to medium findings. Depends on the size of the manager, depends on the capabilities and the infrastructure they're running. And to conclude my session, when I'll be always asked, what are the kind of key points I need to, or how should I prepare for ODDs? And generally it's very simple. I mean, do your homework, understand the ODD process. There are a lot of information out in the market, how to prepare for ODD and what are the common questions you ask. Also have the daily discussion with the investors. What are the kind of points they're looking out? What are the concerns? Look for the dialogue. As well with the ODD expert, as mentioned, take advantage of this ODD process because if it's a good ODD process, it's a consultative approach which shares all the kind of risk and the areas you could further improve. And I say it's paid by the investor for you in most cases. And then also be transparent to the ODD expert, to the investor. What are your risks? What are the areas you have still to work on that? Because you need, this is all built on trust. And if you can't create transparency and provide relevant information to get a comprehensive picture about your business, I think investors will have significant concerns to continue partnering with you. And as well, one aspect I notice sometimes, be consistent in your information. That means what's written in your policy, but what you actually practice and what you represent in the ODD discussions is very different. And that creates a lot of concerns from our side as well, because yes, policies are there, sometimes they're standardized, but you should tailor it to your business. Make sure your staff understand what they're doing and they're consistent in their approach. And that's what they should represent as well to the third parties and service providers or ODD experts. So that's in a nutshell, a recommendation we usually give to managers how to prepare for ODD. And yes, that was my presentation. Thank you very much. And I'm happy to answer any questions.
Awesome, Igor. Very, very good presentation. And essentially, I invite the audience to ask any questions. I guess we've gone a little bit over time. I guess we've enjoyed our discussion way too much, it seems. So I guess we'll give it 15 minutes or so for the audience to ask questions. But Igor, maybe just a follow-up question from myself. when you're speaking to some of your institutional investors and you bring up the Singapore VCC structure, has that been a red flag? Because, or not red flag, but has that been a concern? Because it is a relatively new structure. Is that being brought up? Because that's what I'm getting asked on from our end.
It depends where the institutional investor is located. And if it's in Singapore, I think they're well known with it. And we have observed that various stepboards in the regions have already invested in various VCC vehicles. So that happens, as you can see in the news. AAS also set up its own VCC vehicle. Other global managers are also running in the region to accommodate Singapore investors mainly. For foreign investors, let's say US-based, Europe, it's not that in demand. I have not seen any mandates so far which have been invested, but because it still takes a bit of time to educate foreign investors about the VCC vehicles and the benefits of having it.
And maybe that's a question to the panel as well. I mean, are you seeing that being a challenge, that it is a relatively new structure and that it takes a little bit of convincing, or the benefits outweigh those questions?
We've had investors from North America enter the VCC without questioning any of the aspects of it. So, you know, if North Americans prepared to invest in something which is new, then I think everybody will.
Yep. I guess, guys, maybe we can go through some of the questions that the audience had, I guess, just in the interest of time. So we had one from Stuart. Can managed sub-funds be transferred to another umbrella fund later? I guess this is, again, specific to the VCC. Maybe one for you, Brendan. Can a, let's say, sub-fund under VCC be then spun out under a new entity if you change the investment manager?
Yeah, I think currently there's no mechanism for that. So you would have to obviously effect that indirectly through an asset transfer. But obviously, if you're gonna be investing in real estate, for example, then that would not be ideal. But short answer is not at this juncture. So I guess, you know, for a lot of the platform users, what we've seen is that they much rather, you know, have the VCC hold the management shares so that they retain that flexibility. But if they come into a sub fund, then they run into that issue down the road if there's a need to change for whatever reason. Understood.
And Omar, if I could, you know, just kind of backtrack to the first questions in respect of have managers or has the industry kind of embraced the VCC? And I think from what we can see, I believe so. I think one of the key points in respect of what's happening globally is that, you know, having an onshore structure is a lot easier for whether it's onboarding with Prime or whether it's opening a corporate banking account. And those very facts, the ease of onboarding, the comfort that investors and financial institutions have with respect to the Singapore onshore structure does make quite a difference in respect of starting a fund and bringing money and launching it on time.
And I guess this is probably a good follow-up question which has come from Aditya. I guess his question was a follow-on to your question, Omar. When managers are considering fund structures, the general understanding of Cayman and Bermuda structures are pretty well known amongst the market and investors. So what are some of the key positive features of the VCC versus others to consider when they're deciding to set up a fund structure? So maybe this is one for the panel. So I guess more on the, let's say, positive features of the VCC relative to, let's say, Cayman, for example.
I think the economic substance aspect of the jurisdiction is really the key advantage. So Singapore can't be accused of just being a rock in the ocean for tax evasion. You know, it has a fully functioning financial system, brokers, dealers, custodians, blah, blah, blah. Whereas Cayman can't claim that industry support.
Well, I guess I'll add to that. I guess, you know, if you have a Singapore manager and you have a Cayman structure, then invariably you're going to have two sets of service providers. And I think on an ongoing basis, that may rack up your cost. At the same time, I guess, you know, opening bank accounts, stuff like that just takes a little bit longer from my experience in the Cayman. And yeah, it seems like it's getting a little bit more regulated now. I guess last year in August, they introduced the registration requirements. You know, you need to audit and stuff like that. So that just all translates into cost. I guess as a practical matter, maybe it's not so important from an institutional investor standpoint, but obviously with the grant scheme, the establishment expenses is a lot lower for a Singapore VCC for now.
Thanks, Brendan. I'll just go to the next question. Maybe this is one for you, Damayanti. Can you please explain the requirements around an exempt person, which is exempt from any licensing requirements in Singapore?
Sure. So like I said, in order for you to manage a VCC, either you have to be a regulated fund manager fitting under the buckets we discussed, whether it's the LFMC, RFMC, VCFM, or you have to be duly exempt. So there is some kind of regulatory oversight. And to answer that question specifically, when you're looking at the exempt category, you're essentially looking at an existing financial institution that's already regulated for something like banking or merchant banking or financial advisory. And so they become exempt in the sense that they are already subject to MAS's oversight, but they don't need to tack on a fund management license. So they're essentially regulated financial institutions under another bucket. So there's nobody that's sort of scot-free of the need to be regulated in order to manage a VCC. I think that's the bottom line here.
Thank you. Next question from Louise. As for S13R, the minimum business spending of SGD 200,000 per year for tax grant is to include local and overseas spending, while S13X is limited to, is this limited only to local spending?
Yeah, so I think that was a point I raised earlier in my presentation. So if you read it, 13R doesn't have the word local, so just literal interpretation is that overseas expenses. So to the extent, for example, you use an offshore broker and its expenses outside of Singapore, that should count as well. But 13X is quite clear; it's all local business expenses.
Thank you. And then one more question we had is, what is the effective difference between setting up a normal trust and making a recallable return of capital from that trust and a VCC?
Well, I think the key difference, obviously, in the trust structure, you have to appoint a trustee, which is additional cost. So if you don't have certain scale, it may not be cost effective. So which kind of empirically is why most of the unit trusts are retail funds. And I guess in structurally speaking, the VCC is a body corporate, whereas the unit trust is constituted by a trustee. And from that perspective, there are certain tax differences in terms of tax treaties. It's accessible directly by the VCC, not so much the unit trust. And certain incentives are only applicable to body corporates like the 13R exemption, not so much the unit trust. But yeah, I think in terms of if you're saying whether it achieves the same structural end goal in terms of the redeemability function, I think there isn't too much of a difference. It's just some of these other practical considerations that, when put together, makes one more appropriate and a more appropriate form over the other.
And I guess given there's no further questions, maybe just a parting thought, given the time has run a bit further than we thought. Maybe from each of you, I mean, what should an emerging fund manager that's looking to set up really consider, and what can they do to, guarantee their success rate in setting up a fund in Singapore? Or well, improve their, not guarantee, but improve their success rate in setting up their fund in Singapore? What sort of considerations should they have in their mindset?
I think just maybe I'll start. I think Singapore, generally speaking, you want to survive in this jurisdiction long term. You gotta put compliance at quite high up, sort of the hierarchy of things that you need to sort out. There are a lot of things that that requires fund managers to be cognizant of, and I think having a strong compliance partner will definitely help. I guess Singapore is fairly flexible as a jurisdiction, but at the same time, once you get on the wrong side of the compliance front, I think I think as someone mentioned earlier, the rep risk can be sometimes not recoverable from. So I think compliance is quite important.
I will add to that and say that being able to focus on your investment process is ultimately what produces a return for investors. And if you get sidetracked into areas that you're not familiar with or expert at, such as compliance and administration, then you're going to suffer. So you need to focus on your core skill.
I would second that opinion. Omar, you and I know that for managers who may come out of the big banks, starting up their own startup and trying to manage their portfolio, yet being the marketing person and then handling admin duties, it's incredibly difficult to be good at one and not suffer on the other two. So I think that it requires a bit of thought in respect of when they start out the fund. There's a lot of considerations to factor, and it doesn't hurt to really look at it in the short term and long term in respect of are there platforms that they can kick off and then launch the business first, and then when they build up to a certain AUM size, that's where they can look at other options. So really it's a phased approach, especially if you're a manager nowadays in Singapore looking to launch a fund.
And I'll just sort of further that point by saying that it's important, especially at the beginning, so that you don't waste time and or resources, that you understand full well what the requirements are before you dive in. Because I think anything that's sort of half-baked is likely to face roadblocks along the way. So the need to give it that thought, that time, reach out to whoever you need to in the ecosystem to get the right advice before you dive in, and keep that same philosophy on an ongoing basis as well, as things remain complex as the other speakers have mentioned. But at the same time, this is a location that has it all when it comes to the assistance you need. So I would say don't be deterred.
Yeah. I would say I agree with Damian on this. The ecosystem in Singapore is quite strong. You have various service providers and partners, as our panelists today, on the market who can support you. And I think it's important to reach out to the right partners who can support you in the initial stage. So you, as an investment manager, you can focus on generating the alpha and attracting investor and not caught up with any operational regulatory issues.
I think it's most important to always talk to your different service providers to get a breadth of ideas and to better understand structurally what the VCC can do for you and other fund structures that is available in Singapore. And also talk to your investors to understand their concerns, whether actually a Singapore structures is something that can be relevant to them, in terms, especially for the tax perspective.
I think from my end, I think, chance of success. I would say, because I speak to a lot of startup fund managers, and when I was at Swiss Asia, I saw a lot of fund managers grow from, 5 million to $500 million. And I would say, skin in the game. Have some of your own money in your funds, right? I think if you're not invested in your own strategy, why should others also put in into your fund? So I think having some skin in the game, showing confidence in your own methodology rather than just collecting the management fee, I think that's very key, I would say, in succeeding. So really appreciate everyone for coming along to our webinar today. Appreciate the panelists for their insights. We will share the webinar with everyone as well. We'll send out the presentations and the contact information of any of the panelists. And if you want us to connect you to anyone, please do let us know. But appreciate everyone joining today, and we'll definitely do this a bit more often, maybe once a quarter, just giving an update on certain market trends. So thanks everyone, and until next time.
Thank you.
Thank you.